Have you ever wondered how much it actually costs to build a hotel? Not a small boutique, but a full-scale, modern hotel. The answer is staggering: hundreds of millions of dollars, sometimes even more. But here's the twist. Global hotel giants like Hilton, Marriott, and Hyatt hardly build hotels anymore. In fact, they barely even own them. Yet their revenue has exploded, and their profit margins have hit historic highs. What exactly happened? How did the hotel industry flip its business model so dramatically? Today, we're going to explore how the global hotel industry was completely transformed, why the traditional hotel business model has essentially disappeared, and how major brands became far more profitable by owning almost nothing. 1. The old world. Build, own, operate. A century ago, the formula was simple. Pioneers like Cesar Ritz, Conrad Hilton, and J. Willard Marriott bought land, constructed hotels, and ran them directly. You owned the building, hired the staff, maintained the property, and took every risk. This model worked until it didn't, because traditional hotel ownership carries one fatal weakness: massive fixed costs. Even if not a single guest checks in, housekeeping still works. The front desk must stay open, utilities and maintenance continue. The building still needs to be heated, cooled, and staffed. Meanwhile, travel demand is one of the most cyclical industries on Earth. Peak seasons and low seasons are dramatically different. Economic downturns empty hotels overnight. It's not uncommon for room rates to swing fivefold between seasons. 2. The digital shock, online booking platforms. Then came the 2000s. Online travel agencies, Expedia, Booking.com, Agoda, Hotels.com, gave customers the ability to compare dozens of hotels instantly. Price competition intensified. Hotels poured billions into buildings, yet had to pay commission fees just to sell a single room online. Margins shrank, risk increased, volatility became extreme, and the cracks in the old model widened. 3. The turning point: asset-light transformation. Around the early 2000s, a revolution began. Major hotel chains realized something profound. Owning hotels was the least profitable part of the hotel business. Owning the brand was the most profitable. So they made a bold decision. They began selling off their real estate, thousands of properties worldwide, and transformed themselves into brand licenses and management companies. Hilton spun off its real estate arm. Marriott shifted nearly its entire portfolio into franchises. Hyatt followed the same trajectory. Today, across major chains, less than 1% of hotels are owned by the brand, while over 99% are owned by independent investors, developers, funds, and REITs. What do brands get? A percentage of revenue, often 5 to 15%, plus marketing fees, loyalty program fees, and sometimes management fees. What do they give? Their name, their standards, their reservation system, and their global customer base. And they build nothing. 4. Why this model is so profitable. Let's look at the numbers. Before restructuring, many global hotel chains operated with margins near 20%. After adopting the asset-light model, that number jumped to around 35% or more. Return on capital skyrocketed. Capital expenditures collapsed by half or more. Risk shifted entirely to property owners. Brands became more scalable, more stable, more resilient, and dramatically more profitable. During the pandemic, when global occupancy dropped more than 50%, Many major hotel chains still generated positive free cash flow. If they had owned those buildings, many would have collapsed. 5. Why owners choose to pay the brand. If hotel brands take a cut of revenue, why do owners willingly pay for it? Because branded hotels consistently earn more. A Hilton, Marriott, or Hyatt sign can increase room rates by 10 to 20%, boost occupancy, and attract loyal customers. And loyalty programs are the real superpower. Marriott Bonvoy, Hilton Honors, World of Hyatt. These programs create powerful network effects. Members stay within the same brand families even if rooms are more expensive because of the benefits, points, and status. For hotel owners, joining a global brand often means higher revenue, higher occupancy, stronger marketing reach, and a built-in customer pipeline. 6. The Airbnb question. What about Airbnb? Many predicted it would destroy hotels, but data shows a different reality. Airbnb exploded, yes, but major hotel chains also grew faster and more profitably during the same period. Why? Because they serve different markets. Hotels excel in business travel, consistency, cleanliness standards, 24/7 service, loyalty perks, last-minute stays. Airbnb excels in unique spaces, multi-room homes, long stays, leisure travel, larger groups. These two models overlap slightly, but they don't replace each other. If anything, Airbnb expanded the global travel market rather than shrinking hotels. 7. Why luxury hotels remain brand-owned. There's one major exception: ultra-luxury properties. Ritz-Carlton, Park Hyatt, Waldorf, Astoria are often still owned or tightly controlled by the brand. Why? Because these flagship hotels define the brand itself. Any drop in service quality would damage the global reputation. Luxury hotels also generate higher margins, face less price sensitivity, and remain stable even during downturns, so the brands keep them close. 8. The future of global hospitality. Looking ahead, several global trends are reshaping the next era. Automation, AI check-in, digital keys, contactless services, hyper-personalization, rooms preset to a guest's preferred temperature, lighting, pillows, and amenities, sustainability, energy efficiency, water conservation, zero-waste operations, subscription models, monthly or yearly passes for digital nomads, wellness integration, fitness, recovery, and health-centered experiences, data-driven optimization, pricing, occupancy, and service personalization powered by algorithms. The hotel of the future is more than a building. It's an ecosystem built on loyalty, brand trust, and technology. 9. The big lesson. The reinvention of the global hotel industry teaches us a powerful principle. Business models are not permanent. Even century-old giants completely abandoned a model they used for 100 years and embraced a new one that fit the changing world. Their success came from the power of branding, the strength of loyalty programs, risk management, and the willingness to adapt. The hotel chains of today are no longer just places to sleep. They are global experience companies, lightweight, flexible, and incredibly powerful. And the next time you see a Hilton, Marriott, or Hyatt sign, remember, they probably don't own the building, but they own something far more valuable: the brand, the loyalty, and the trust of millions of travelers.